Happy Wednesday, everyone. I don't know about you, but my Wednesday is off to a great start, and I'm hoping the same is true for you. Let's get right into today's market update. Well, markets are starting off fairly quiet. Mortgage bonds are nearly unchanged, and the 10-year Treasury yield is holding steady around an important technical level that we've been watching. That's good news for rates in the short term, but we've got some big headlines that could move things as the week goes on. Let's start with comments from John Williams, the president of the New York Fed. He's always a voting member, so what he says matters. But honestly, some of his insights this week were a real head scratcher. First, when asked if mortgage fraud is serious, he kind of sidestepped the question completely. Now, you and I know that the answer is obvious. Of course it's serious. But for one of the Fed's top officials to not even acknowledge that, it's kind of troubling. It's reminded me kind of what we heard last week from Kansas City Fed President Jeffrey Schmidt, who brushed off similar concerns by saying that the mortgage process just involves too much paperwork. Imagine trying to use that excuse if one of us messed up in a loan file. Next, Williams talked about the September Fed meeting. He didn't commit to a rate cut, but he did point to the Fed's R-star number. Quick explainer, R-star is basically the neutral rate that the Fed uses to judge whether they're restrictive or not. Williams suggests that the R-star is about 0.7%. That means the Fed's current policy is still nearly a full percentage point restrictive. In other words, they could cut rates and still be restrictive. That's something we've been saying for months, and it's good to finally hear it from them. On inflation, Williams admitted that outside of tariffs, inflation is cooling, and even housing costs are slowing. But here's what he missed: the lag effect. Owner's equivalent rent, the housing piece of inflation, still looks elevated in official reports, but the real number are already much lower. That lag is overstating inflation by about 0.5%, and ignoring it makes the Fed sound more hawkish than it should be. Then came the labor market. Williams used the same word we keep hearing, solid, but the data doesn't back that up. Continuing jobless claims are at their highest level since 2021. The gig economy, which is Uber drivers, DoorDash, and other 1099 work, means that a lot of folks don't even qualify for unemployment benefits. So those low jobless claims don't tell the full story. And if you look at the U6 unemployment rate, which captures underemployment, that's up to 7.9%. Surveys show that people think that jobs are harder to get and they expect fewer opportunities ahead. Calling that solid feels like willful blindness. We'll get more on jobs tomorrow when we see the updated claims data, but for now, it's fair to say that the Fed is still painting a rosier picture than reality is. Now let's pivot to housing and mortgage news. Mortgage applications, well, purchases were up 2% last week. Refinances were down a little bit. Year over year, purchases are still up 25% and refis are still up 19%. That's strong considering rates were still around 6.625% last week. This week, rates are closer to 6.5%, so we should see stronger data in the next week's report. Existing home sales. According to NAR, sales ticked up 2% in July, reaching an annualized pace of just over 4 million. That's still historically soft, but it's an improvement. The median sales price came in at $422,400, basically flat compared to last year. It's the slowest year-over-year price growth that we've seen since early 2023, which is welcome news for buyers. Mortgage rates. After Powell's remarks at Jackson Hole, the average 30-year fixed fell to 6.52% as a national average. That's the lowest level of 2025 so far. If rates keep trending downward towards 6% and stay there, expect housing data to pick up significantly. Now let's switch to insurance costs. On the affordability front, homeowners insurance continues to bite. Premiums are expected to rise another 8% this year to over $3,500 annually. Not everywhere, but overall. In some states like Louisiana, insurance makes up nearly 20% of a mortgage payment. That's a huge affordability strain. And researchers estimate insurance hikes have already caused nearly 150,000 new mortgage delinquencies in just the last 2 years alone. Now let's talk about some legal battles. There's a Michigan judge that struck down Rocket Mortgage's non-competes, calling them overly broad and saying Rocket is basically a telemarketing operation. Keep that in mind when you're shopping for mortgages, by the way. Not everyone has your back the same way. So where does this leave us? Well, we've got mixed signals. Inflation's cooling, housing costs stabilizing, rates trending lower, but affordability is still a huge challenge thanks to insurance and high prices. Buyers are getting a little more breathing room, and homeowners remain financially strong overall. As for the Fed, all eyes are on September. Williams may not have committed, but pressure for a cut is building, and if GDP and labor data continue to weaken, we could see relief sooner rather than later. Well, that's your market update for today. Hope you found it interesting. Thanks for tuning in. And remember to like, subscribe, and share as I'm bringing the market updates every Wednesday. And then if anything important comes up, I'll pop up and drop another one in the meantime. With that being said, have an excellent rest of your week. And I'll see you Friday for this week's Ask Me Anything Mortgage Edition. See you guys later.